Okay, welcome back. We are on page 2, and we are right now dealing with intercompany transactions, in particular the basic ones, where you do the same amount, you either increase or decrease, usually it's decrease, to two accounts, usually a revenue and expense, or a liability, or sometimes both. Okay, so let's talk about a loan between the parent and subsidiary, and this time with interest. Just put a little note at the top, more basic transactions. So, suppose the parent lends $1,000 to the sub and receives a note payable on demand with interest at $10 paid annually. From the consolidated entity's point of view, all that's happened is that cash has been transferred from one bank account to another. Okay, all we did was move our money around. No revenue has been earned, no expense has been incurred, and there are no receivables or payables with parties outside the consolidated entity. So this is the same as the notes payable, and we'll do that down here. Right now we're just going to add the interest and expense portion. So we have to remove the 100,000 times 10%, which is 10,000, interest revenue and interest expense on the consolidated income statement, and change the net income. And that means non-controlling and controlling interest is not affected, and therefore income tax is not affected. So the two accounts are interest revenue would have to go down, and interest expense would have to go. Okay, so the parent would have interest revenue, the sub would have interest expense. So both of those would have to go down. And of course, it was part of the way through the year, you prorated or whatever. Now, on the consolidated balance sheet, we've already learned how to do this in Chapter 5. We have to make notes payable down and notes receivable down. And let's just put up here, no interest effect. Now, notice here, if the roles were reversed and the sub lent to the parent, the eliminations are, because when we have our two little columns in the middle after we have parent and sub, and then we have the consolidated, do we care whose it is in here? No. Okay? So it's the same and no effect on the critical things. So there are some other common I guess, basic transactions, intercompany management fees. Parent will charge its subs a yearly management fee. A way of allocating head office cost, all the companies in the group. Of course, once we're in the consolidation circle, all it is moving money around back and forth. So for consolidation purposes, we have to eliminate them. Remember, you go on their own books that are nowhere near the consolidation laptop or circle or whatever you want to think. Their separate books are perfectly right. There's nothing wrong with them. It's just when you do consolidation, you've got to eliminate the stuff that's this. So we're going to take revenues and expenses down. So all these little changes are going to be added in these two columns when we're doing the direct method, or you'd have elimination entries. So you can see right here you'd have another 3 sets of elimination entries. That's one of the reasons I'm staying away from them right now. I just want you to get the whole consolidation idea down first. Okay, intercompany rentals. Often a parent and sub will rent each other buildings, equipment, that kind of stuff. Rather than transfer legal title, they just go on a yearly rental charge. So again, we're going to have to take revenues and expenses down. Can't move, Dace. Oh, sorry, my dog. Under my foot. Okay. Now, just to make sure you've got this, let's say we have a little example. Parent sold sub, inventory, and sub still owes 1,000 on the inventory. Okay, so that's the important part. I want to know what you're going to do with owing it on the inventory. Well, what are you going to take off? Where does that owe on? On the balance sheet, right? As an accounts payable for one and accounts receivable. So these guys would have an accounts payable, these guys would have an accounts receivable. So we have to put AR down, AP down. That's for 1,000. Okay, so that's the end of the basic transactions. Hopefully they're straightforward. Now, as part of all our little schedules we make, listing basic transactions is totally optional. You never have to do it. I find if you're working, because these questions get long, if you're working with your questions, I suggest writing it down, especially when you're new at it. That way you won't forget them, because I can't tell you how many people forget to cancel the sales and cost of goods sold from one parent selling to the other. So just be really careful. Okay, now let's go on to page 3. And I know it's kind of a rough drawing here. I scanned this and put it up under Chapter 6 notes underneath it. So if you want to print that off, because I'm going to be talking about it, and I'm going to use Lego to hopefully get you to understand it. We'll see. Okay? But just put it on pause, go print it off if you want. It's just on Blackboard. Okay, so now we're talking about intercompany, not just transactions, but profits that have been to assets that we've transferred. So, when assets are transferred between related companies, the profit gained or lost cannot be recognized in the consolidated statements if it has not been earned. Because as we said on the last page, for profit to be earned, it's got to go outside the circle. So it must take place with a party external to related entities. So I'm going to say outside the consolidation circle. Therefore, some profits, because you notice in the other one, on the last page, if we took down revenue by 10 and cost of goods sold by 10, are we changing net income? No. No change in net income or profits. Now we're looking at some part of the profits, unrealized, may need to be eliminated during the consolidation process. Okay? So we're going to focus first on profits in inventory and profits in non-depreciable assets, which is just land. And in this chapter, in chapter 7, we'll do depreciable assets because it just takes it a little bit crazier. Okay. Yeah. So there's a lot of little things you need to know for this. So, 2 terms you need are downstream transactions, because they're going to affect the parent's calculations in consolidation calculations, and upstream, because they're going to affect the subs. If the parent sells to the sub, that is downstream. You can think of a sub as a kid. Parents are looking down because the kids are short. And it's if the sub sells to the parent. Okay, so downstream, upstream. Now, also, one sub selling to another sub, because of course there can be multiple subsidiaries. One sub selling to another sub is also downstream. Oh crap, upstream, 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 you guys. Not paying attention. Okay, direction makes a difference because it's the parents and NCI doesn't own the parent. Okay, so that's downstream, upstream. Now we're going to look at income taxes. Income taxes are reintroduced in the chapter and will have the following effects. If income tax expense is adjusted on the income statement, its matching account on the balance sheet, deferred income tax. Okay? So if income tax goes down, deferred income tax is going to go up. Okay? And just so you know, income tax expense shortcut for it because there's not much room. Now, Connect has you use one DIT account for debits and credits. I'm just going to use one net account, and it varies in practice. So this way you'll kind of see both. So as we mentioned last time, income tax expense is based on your net income. And don't worry, we're not using all the rules of tax and everything, that's separate. We're just doing a nice simple calculation. So if equal amounts of revenues and expenses are eliminated, does net income change? No. So income taxes will not change. So basic transactions don't change income tax expense or DIT. Now, one thing that we do in this course is simplify some of the things. We want you to get the basics of consolidation right for CPA. Then after that, if you're working in it, and they do a little bit in Core 1, then you'll add to it. So, on the changes in acquisition differential schedule, which we did last chapter, technically, the amortization of property, plant and equipment should be adjusted for tax, but in this chapter, we're assuming they're not taxable just to match with the textbook. In real life, you would adjust the income tax expense account as well as DIT, and that's for changes in AD amortization. Now, on the new schedule, unrealized, realized profit, it's also called intercompany profit schedule. Income tax expense and DIT will be adjusted. Okay, I'm going to stop here so I don't get cut off and go to our little extra page that I put on Block.